Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Good, I hope. Hey, well, we normally taste a little sample of some bourbon, whiskey, or scotch, whatever it may be. Today, we're going to be doing Iron Smoke Straight Bourbon Whiskey. These guys have a pretty cool story, and in fact, the next three that you see will be out of the little Flaviar thing. We're not like affiliated with them or anything, but me and Charlie like to participate here. The next three that you see will be from New York. So this is a New York bourbon whiskey with what they say is a hint of applewood smoked barbecue. And that's their thing. They mix the bourbon and char or smoke with a little applewood taste in there. And it smells just like that. Would I have known that if they didn't tell me? I don't know. But it's definitely spicy and caramel. But you can see the little card there. We'll get right into the good stuff here in a second. But that is, in fact, a bourbon that feels like it came out of a barbecue. Not a huge fan, actually, of that, but we'll see. Up next here in the next couple videos, we got Widow Jane and Black Button, it looks like. Anyways, grab a drink, hang out with me here for a minute. We're going to do a study. We're financial advisors here at Jazz Wealth, and so a lot of our focus is on the study of portfolio performance. We'd like to analyze that. We're kind of geeky. If you're one of our clients, you see our notes from Jazz email. There's always good stuff in there. We love getting into the data. Now, we'll do something a little different here. We're going to pretend that you have just made a big mistake, all right? You are an investor who's invested $200 a month, regardless of what happens, right? And then the market falls over 10% and you say, ooh, I don't like that. I'm going to stop my $200 a month until the market is positive again, just for 1 month. That's all you're waiting for. So what we did is we took two investors. Investor A will do the $200 a month no matter what. When the market plummets, he's still going to do the $200. He's going to kick and scratch, but he's going to do it. Investor B says, I only really want to participate in the good times. So I want to be $200 a month. And if at any point the market falls 10% off of highs, I'm going to stop for a minute and wait for that next positive month and keep going from there so long as we're not more than 10% off of highs. Kind of cool, huh? Let's dive into it, see what we got. So we're going to do this, a couple different charts we'll show here. We're calling this person the regular investor versus the market timer. The market timer being the person who stops investing after there's 10% drawdowns. Now, on the screen here, we're going to look at a couple things. The market itself has had, this is over the course of 30 years, 94 to 2004. The market's had 306 positive months that were not down by more than 10%. We've had 55 months that were either down or positive, but still 10% off of highs. And you know a few of these, right? The COVID crash and stuff like that. Clearly down more than 10%. You could have had a positive month in there, but as long as you're down more than 10%, 55 of the months out of all the months, 30 years, you would have not participated in your $200 a month. Now, the first thing that I'm curious about is what would your average cost per share be? Because you would think that someone who does not invest during the down moves cannot lower their average cost. Well, the regular investor has a lower average cost per share. So you guessed it. The market timer's average cost per share is in fact higher. That's going to hurt returns. And all that is because they paused their $200 a month deposits when the market was cheap because they were scared. Right? They decided not to participate. Right? So they have a higher cost per share. Now, it also means that they purchased less total shares, in this case, of the SPY. $200 a month. Naturally, if you never stop, you're going to end up with more shares than someone who invests or who pauses their investments. Now, the total invested is $11,000 difference. Over 30 years, the normal investor, $72,200 a month. The market timer, of course, with those months that they had to pause, $61,000. Not a large difference there. So it's really interesting to see that with an $11,000 difference, the cost per share is actually not that far off, but the total number of shares, fortunately, is with just $11,000. Now, where was the other thing? Oh, total invested, right? We just said that. So we got 61,000 versus 72,000. If we look at the total value of their portfolio over the 30 years, that $72,000 turned into $438,000. The 61,000, only $332,000, making it a 507% return versus a 442% return for the person who decided to pause. Now, we went over conditions here, so I'll put it all together for you. We have total invested, total shares purchased, and total final value there. Despite having $11,000 less, or about 18% less in total capital there, the market timer ended up with $106,000 less, or 24% less than the investor who just continued and just almost like didn't pay attention and just did whatever they had to do. So the moral of the story is that's the data. It is no longer opinion whether you should be investing during the good times and the bad times in like your 401k, right? Like if you have a play account and you want to play some games with like a brokerage account, I'm not talking about that. I'm talking about the long-term investments. We now know, or clearly, that the data says you got to fight through those downturns. And I would argue if you had an extra $20 during those downturns, go for it. We could even do that as a study if you want. If we say you're always doing $200 a month, but anytime there's more than a 10% pullback, you do $220 a month or $250 or something. How cool would that be? Maybe that's a lot for someone who might be losing their job during these downturns, but what a cool study. Keep at the consistent investing. And most importantly, make sure you know exactly how much you're supposed to be investing. $200 a month, is that the amount? Maybe you are supposed to be $162.50, or maybe the next person has a more lofty goal and should be $375. Like figure out that number. And if nobody's doing that for you, come on over to Jazz Wealth. Happy to help you there. We are financial advisors in every sense of the word, the 66th best financial advisor in all of America, according to USA Today. That's their rules, not ours. We didn't pay for it. Hey, thanks for watching. Hope you learned something. Use the data. All right. See ya.